India's second largest private bank doubled its profit for FY21. ICICI Bank's bottom line performance was driven not only by receding asset quality woes but also by strong loan growth, highlighting the bank's transition from a stressed bank to a growing lender. So how did ICICI Bank emerge stronger from the pandemic-induced economic crisis? It is clear that the bank has learned the lessons from the crises it faced in the past: retail asset quality troubles in 2008 and corporate bad loan cycles in 2014. In the current crisis, the bank acted quickly to protect its balance sheet, which was painstakingly cleaned and made stronger in the past decade. ICICI Bank's NII increased by 17% on a yearly basis, but non-interest income fell by 8%. What was the hallmark of the bank's performance is the fact that operating expenses remained exactly the same compared to FY20. As a result, operating profit got a huge shot in the arm as it jumped to 17% YOY. As far as PAT is concerned, profit after tax increased by a whopping 104%. The bank's CASA ratio stood at 42%, with the cost of funds being amongst the lowest at 4.25% in FY21. An increased share of high-yielding retail loans at 67% of total advances boosted ICICI Bank's NIMs on its domestic book in the range of 3.7 to 3.9%, which is comparable to the best. Asset quality fared better, with GNPAs trending lower and restructured assets at 0.5% of advances book. For Q4 FY21, the bank created 1,000 crores of COVID-related provisions, taking the total COVID-related provisions to 7,475 crores, equivalent to 1% of loan book as of March. With Tier 1 capital adequacy at 18.06%, the bank is more than adequately capitalized and well poised to capture the growth opportunities in the post-COVID era. Domestic loan book increased to 18% YOY, led by retail and SME lending, and after many quarters, corporate lending saw good traction and grew by 10% on a yearly basis. Mortgages, which constitute 50% of retail loan book, saw a growth of 22% in FY21. Other segments within retail, especially the credit cards, also posted a reasonably good growth. Deposit growth was robust at 21%, driven by 24% growth in CASA. The growth in term deposits also was healthy at 18% year on year. Talking about the risk factors, despite the improvement in asset quality, one cannot say there will be no more bad loans. If the second COVID wave persists for longer, bad assets for ICICI Bank could inch up. But additional provisions will support earnings, as potential problem assets have already been provided for to some extent. And despite a good pickup in domestic loans, the growth in the overall advances book was lower at 14% due to a 30% contraction in international loans. Though this is in line with the bank's policy to focus more on the domestic segment, in the near term, it could impact its performance. Balance sheet strength is paramount for a bank, and having achieved it, ICICI Bank is likely to see strong earnings growth in the coming years. The bank's valuation is reasonable according to experts, not fully capturing the significant improvement in business fundamentals and the growth story. While the stock has done well in recent times with the receding asset quality woes, looks like there's more steam left in the stock's rally. With bad loan formations reverting to normal levels, the quick pullback in the stock valuation in the past couple of years was perhaps just the first part of the rally. In the second part, investors can expect re-rating to continue, with a surge in earnings aided by strong top-line growth and limited provisions. At the current price, ICICI is trading at 1.5x of FY23 estimated core book value, which seems reasonable considering that the ROE has inched up to 13%. In terms of relative valuations too, ICICI is trading at a significant discount to its closest retail lending peer, offering a room for meaningful re-rating.